Compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. Eighth wonder of the world, huh? That's quite a praise for a concept, especially coming from someone like Albert Einstein. So let's try to unravel the significance of this concept called compounding and how can we take advantage of it, not just in our personal finance, but also in our personal lives as well. I was reading a book called The Psychology of Money by Morgan Housel, and I came to know about the story of two guys, Jim Simmons and Warren Buffett. Now, we all know about Warren Buffett, the owner of Berkshire Hathaway, one of the most successful investors in the world and the sixth richest person in the world. And Simmons is the founder of a hedge fund called Renaissance Technologies. Now, when it comes to earning average annual return on investments, Jim Simmons surpasses Buffett by a lot. While Buffett's investments earned him an average annual return of around 22%, Simmons' investments earned him a compounded annual return of 66%, triple of that of Buffett's. But Simmons' net worth in today's times is 75% less than that of Buffett's. Now why is that? Because Simmons got his investment stride from the age of 50, while Warren Buffett started investment from as early as 11 years, and he has been doing that ever since. Now this is the crazy part. Had Simmons made that kind of return which he has started making from the age of 50 for a period of 70 years, which means if he had started as early as Warren Buffett, his net worth in today's times would have been 106 quintillion, 75 quadrillion, 197 trillion, 756 billion, and $42 million. This kind of craziness is only possible because of compounding. Now, compounding in financial parlance means anything that you earn from your investment, which may be in the form of interest or capital gain, is reinvested again along with the principal. Now, the longer you're involved in the game, the better it is for you, because that particular amount of capital gain or interest will get reinvested again and again and again. And also why it's important to think long term is you would begin to see that kind of return or growth which you cannot fathom only towards the end of that long-term period. This kind of growth is something that you would call exponential growth, and an exponential growth curve looks something like this. So let's shift the computer and let me show you a practical example of what compounding can do for you. So here, as you can see, there are three columns. So the first column here represents the number of years, and the second column represents the annual investment amount, and this third column represents the value of your investment at the end of each year. Now here I have considered an annual interest rate of 13%. This is just for demonstration purposes. I mean, you can take any rate you want. And the monthly investment amount which I have considered is 5,000. And here is the starting age, and here is the retirement age. And this represents the duration of your investment. This represents the value at the end of your investment period that you would have if you keep investing. So if you're investing 5,000 rupees every month, this table here calculates the value of your investment at the end of every year. So now let me explain, because if you're investing 5,000 rupees every month, the value of your investment at the end of that particular year would vary depending on your investment month. So if you're investing 5,000 here, at the end of the year, you would have 5650. If you're investing 5,000 in February, at the end, you would have this amount, because you're investing for only 11 months. Again, if you're investing in March, you're investing for only 10 months. So that's how we arrive at the end amount here that you would have at the end of the year. So now coming down to here, you can see at the end of first year, you have 64,225, which is coming directly from here. Now, compounding kicks in from next year. So what's happening in next year is, don't get scared by this formula. So let me break down this amount. So at the end of the second year, you would have the normal amount of rupees 64,225, because in the second year also you're investing 5,000 every month for 12 months. So at the end you would have the same amount, which is 64,225. And along with that, you would also have this particular amount being reinvested again. So at the end of the first year you had this amount. So if I grow this amount by 13%, let's see what we have. We would have this amount, and this amount is coming from the second year itself. So if I total this, I'm having 136,799.25, which is the same amount here. So this is how this amount is coming. Compounding is happening because of this figure here, because this amount at the end of the first year is getting reinvested again at the rate of 13%. So similarly, if I need to calculate this amount as well, how this came, at the end of the third year also you would have 64,225, because you are again investing 5,000 rupees every month for 12 months, which is 60,000. So at the end you would have this amount 64,225. Along with that, the amount that you had accumulated at the end of the second year, even that would get reinvested at the rate of 13%. So I'm growing that by 13%, which is coming to this. So when you add this, it's coming to 218,808, which is this amount. So again here compounding is happening because of this figure here, because this amount is getting reinvested, and because of that you're arriving at this particular amount. So this is how compounding works, because all these amounts have interest included in them. So the rate of 13% interest which you have here, this amount is included in all these amounts, and again these amounts are getting reinvested here. So 64,225 got reinvested at the end of second year, 136,799 got reinvested again to arrive at 154,583. So this is how compounding is kicking in, and as you would go down, the effect of compounding would increase. So now let me show you as to how the graph would look if I take these amounts, if I consider all these amounts, and if I plot a graph here. So let me plot a line chart here. So as you can see here, this is how exponential graph looks like. So you can see from the first year till I would say year 28, there was not much of a growth, but then from 28 years onward, you can see this jump, this climb. So in order to take an advantage of compounding, you would have to remain invested for this period of 32 years. And only then you would see this jump here. And the longer the period, the better it is. If I say you start investing at the age of 10. So this is just for demonstration purposes. I'm not suggesting you start investing at the age of 10. If you can, it's very good for you. But the longer the period, the better it is. So I want to show that effect. So if I take a duration period, investment duration of 80 years, and I adjust the graph accordingly, you would see the steep growth at the end of the graph. So are you seeing this? This is what compounding looks like. This is an exponential growth. So for this period, it was almost flat, and at the end, the vertical climb here. So this is how compounding would look if you keep on investing. And one more thing which I want to highlight is, so you can see the end amount here is 27 crores 6,80,000. Now just consider this simple fact. If you keep investing 5,000 rupees every month for a period of 55 years, at the end you would have 27 crores. That's bonkers, right? So well, let me just make it still more conservative and say if you keep investing till 60. So now you have 1.5 crores. Now see the magic here. If I increase this by just 1%, this increases to 1.8 crores. Now this effect would be more if the duration is more. So if I bring this down to 20 and if I bring this up to 80, so now you have around 75 crores. So now if I change this to just 1%, now if I just change this to 1%, this went to 120 crores. Just by a change of 1%, the amount almost doubled here. So this is what compounding is, and this is happening because you have 60 years of investment duration. So this is what I wanted to show you as to what is the effect of compounding, and if you are in the game for a long period of time, what it can do for you. So a point which I realized while editing this video is this won't be interest, this should be return, because you do not earn any interest when you're investing in the stock market. You get a return. So don't consider interest in the past demo which I showed. That would be a return. And also one more point is, this is an average return which you would be earning every year. So do not expect to earn 12% return each and every year here, because since this is the stock market, in 1 year you might earn 5%, in the next year you might earn minus 2%, again in the next few years you might again start earning 20%, 30%. So that's how it would work. But on an average, you might expect to earn 12% to 12 to 13% or whatever you consider. So this is important because this is an average, and this point in particular makes it all the more difficult to stay invested during this period of time, because there would be years wherein you would earn negative rate of return, and you would still have to stay disciplined and remain invested during those years. So this is one point which I wanted to add at the end of this demo. In fact, if we look at Warren Buffett's timeline of wealth building, it would look something like this. Warren Buffett started investing from the age of 11 years with $120, and by 19 years he had $9,800 as his savings. Now, by 59 years, his net worth had swelled to $3.8 billion. But the crazy number is where he is at today, $104 billion at age 91. So when we put this in a graph, we see that climb after his 60s, which is again an exponential graph. And this is what Morgan Housel has to say about Warren Buffett from his book, The Psychology of Money. Warren Buffett is a phenomenal investor, but you miss a key point if you attach all of his success to investing acumen. The real key to his success is that he's been a phenomenal investor for 3/4 of a century. Had he started investing in his 30s and retired in his 60s, few people would have ever heard of him. Now, this is not to discourage you and tell you that you should have started investing from the age of 11, then you would have amassed a huge amount of wealth by the time you will be 89 or 90. This is just to show you the concept of compounding and the way it works. The message for you from this is, the longer you're involved in the game, the better it is for you. So what you should focus on is starting as early as possible. If you're in your 20s, in your 30s, in your 40s, please do start, because if you do not start, you will definitely not have anything. But if you do start investing in your personal finance or investing time in your personal growth and development, you will definitely, over a period of time, have something on your hands which you would definitely be surprised with. And the good thing with compounding is it's not only applicable in finance, but also in your other areas in life as well. So if you want to achieve any goal or learn any new skill or change your physique, doing the little things every day in a consistent manner for a long period of time is when you get to see significant results. Similar to investing some amount of money every month for a significant period of time. Now, it's difficult to quantify the results in such cases in an Excel sheet, but that's the way how it works. An excellent book by the name of Compound Effect by Darren Hardy goes deep into this concept, and you should definitely check that out. I will give a link to that in the description below. There are two things which I would like to highlight before I end this video. The first highlight is there are two qualities which I would like you to imbibe if you want to benefit from the magic of compounding. The first quality is patience. Unless you are patient with your daily, weekly or monthly habits and investments, you will most likely drop off before that exponential growth kicks in. And patience is really important in today's world of instant gratification. So that's the number one quality which I would like you to imbibe. The second quality is self-discipline. This is the most important quality I feel, because staying disciplined helps in consistency, and consistency is the base of compounding. Without consistency, it's impossible to take any benefit out of compounding. So that was the first highlight. And the second highlight is, it's a good thing that we don't have to be bothered with the end goal or how big or scary it is. Once the daily, weekly and monthly activities are aligned with our end goal, it all boils down to performing those activities consistently in a disciplined manner over a long period of time. And the results which we would get to see at the end, if we continue doing that, would surprise us really. So that's how simple it is, performing those daily, weekly or monthly activities over a period of time, and eventually you will definitely tap into the magic of compounding. So that was the 8th wonder of the world for you and what it can do for you in your life. I'll provide a link to the Excel file which I used in this video, so that you can tweak the returns and monthly amounts and calculate the amount that you want to accumulate over a period of time. If you want to learn about the concept of SIP, you can check out this video, or if you want to see how you should approach life insurance, you can check out this video. So that was it for this one, and until the next one, take care, see you and bye bye.